Welcome to our podcast on ASU 2015-01, Income Statement, Extraordinary and Unusual Items. In this podcast, we'll go over the objectives of the ASU, describe current requirements and the impact the ASU has on current requirements, including what is changing and what is not changing. My name is Paul Fayyad, and joining me on this podcast is Thomas Fenoteau, and we are both senior managers in KPMG's Department of Professional Practice.
So the FASB eliminated from GAAP the concept of extraordinary items for this ASU. The ASU was issued as part of the simplification initiatives, which objective is to identify, evaluate, and improve areas of US GAAP where cost and complexity can be reduced, while maintaining or improving the usefulness of the information provided to users of the financial statements. This update aligns more closely US GAAP income statement presentation guidance with IAS 1 presentation of financial statements, which prohibits the presentation and disclosure of extraordinary items. The ASU can be applied prospectively or retrospectively for annual periods and interim periods within those annual periods, beginning after December 15, 2015, for all entities. Paul, is there anything else that as a preparer I need to know about transition and adoption?
Sure, you need to know that early adoption is permitted, provided that the guidance is applied from the beginning of the fiscal year of adoption. Also, when using prospective application, you are required to disclose the nature and amount of the item included in income from continuing operations that adjusts an item that was previously classified and presented as an extraordinary item. When using retrospective application, you must provide disclosures on changes in accounting principle as described in ASC 250-10-50.
Thanks, Paul. Before we go into what will change with the ASU, let us refresh our memories on what the current guidance is. Subtopic 225-20, Income Statement Extraordinary Items, currently requires that an entity separately classify, present, and disclose extraordinary events and transactions. An event or transaction is presumed to be an ordinary and usual activity of the reporting entity unless evidence clearly supports its classification as an extraordinary item. Paul, can you remind us what an extraordinary item is?
Extraordinary items are events and transactions that are distinguished by their unusual nature and by the infrequency of their occurrence. Both of the following criteria need to be met to classify an event or transaction as an extraordinary item. 1. Unusual nature. The underlying event or transaction should possess a high degree of abnormality and be of a type clearly unrelated to or only incidentally related to the ordinary and typical activities of the entity. And 2, infrequency of occurrence. The underlying event or transaction should be of a type that would not reasonably be expected to recur in the foreseeable future. If an event or transaction meets these two criteria, an entity is required to segregate the extraordinary item from the results of ordinary operations and show the item separately in the income statement, net of tax, after income from continuing operations. The entity also is required to disclose applicable income taxes and either present or disclose earnings per share data applicable to the extraordinary item.
So removing the concept of extraordinary items will save time and reduce costs for preparers because they will not have to assess whether a particular event or transaction is extraordinary, even if they ultimately conclude it's not, and they no longer will have to separately present extraordinary items, net of tax, and the related earnings per share. Now, Paul, it seems clear what the changes are, but if I were a preparer out there looking at this issue, what are the things that don't change?
Although entities no longer need to determine whether a transaction or event is both unusual in nature and infrequent in occurrence, they still need to assess whether items are unusual in nature or infrequent in occurrence to determine if the additional presentation and disclosure requirements for these items apply. Those requirements include separate presentation in the income statement as a component of continuing operations or in the notes to the financial statements. Items that are not individually material but similar in nature should be aggregated. It is important as well for entities to recognize that the ASU does not eliminate the requirement to exclude unusual or infrequently occurring items from the estimated annual effective tax rate for interim reporting purposes. More specifically, such items that are material and will be reported separately will continue to be treated as discrete items for interim reporting and will be excluded from the estimated annual effective tax rate applied to ordinary income.
Paul, will there be a loss of information for the users of the financial statements because of the ASU?
The FASB does not believe so, because while the amendments eliminate the requirements for entities to consider whether an underlying event or transaction is extraordinary, the presentation and disclosure guidance for items that are unusual in nature or infrequently occurring is retained.
So with that, we would like to thank you for joining this podcast today. We hope that the information provided gives you some insight on ASU 2015-01. We would also like to inform you that you can find additional information on this ASU or other accounting updates issued by the FASB through our Defining Issues publications on the Financial Reporting Network website, which is also where you can find additional podcasts and thought leadership publications on a host of other accounting topics.